The Philippines is projected to be the 23rd largest economy by 2039, according to the latest edition of the World Economic League table, published by London-based think tank Center for Economics and Business Research. The projection is a significant improvement for the country, jumping 10 places over the next 15 years from 33rd rank out of 189 economies in 2024. This means that the Philippines will surpass Thailand and Singapore in the coming years, becoming the second biggest economy in Southeast Asia next only to Indonesia. In 2024, Indonesia ranks 16th as the biggest economy globally, while it ranks 10th in the next 15 years. Accordingly, Indonesian economy will continue to lead by 2039, with GDP of $3.7 trillion. Followed by the Philippines, projected to triple its economic size with GDP of $1.5 trillion. Vietnam came close, with GDP amounting to $1.4 trillion. While Thailand's GDP is projected to reach $1.05 trillion. Malaysia's economy will expand to $1.005 trillion and Singapore amounting to $982 billion. This projection was supported by the World Economic Outlook published by the International Monetary Fund. According to the latest IMF World Economic Outlook issued in October 2024, the Philippines will surpass Thailand and Singapore by 2028. The Philippines' economy is projected to increase to $648.9 billion by 2028. Meanwhile, at the same period, Singapore's economy is $641.8 billion, while Thailand GDP is $624.02 billion. By 2028, Indonesia, Southeast Asia's biggest economy, will reach $2 trillion cup. Vietnam will also surpass Thailand with GDP of $628.6 billion. Malaysia will remain the sixth biggest economy in the region with GDP of $587.09 billion. The latest edition of the World Economic League table published by London-based think tank Center for Economics and Business Research, only 3 nations from the Southeast Asia were among the top 30 biggest global economies by 2039. These are Indonesia, which ranked 10th, the Philippines ranked at number 23, and Vietnam ranked at number 25. The report highlights the steady economic growth of the Philippines amid global challenges. Among the 189 economies analyzed, the Philippines' rise underscores its increasing competitiveness and resilience in key sectors, driven by domestic consumption, robust remittances, and a growing labor force. In global economy, the Philippines will surpass economies like Switzerland and Taiwan, which are projected to be ranked 24th and 25th, respectively, by 2039. Other countries in the top rankings include the United States, China, and India, which maintain their positions as the top 3 largest economies. Notably, India is expected to overtake Germany and Japan to secure the 3rd spot by 2039, further emphasizing shifting global economic dynamics. With strong growth forecast over the medium-term outlook, the size of the Philippines' GDP measured in US dollar nominal terms is set to reach $1 trillion by 2033, according to the report issued by S&P Global Market Intelligence. This will make the Philippines one of the largest emerging markets in the Asia-Pacific as well as a leading emerging market globally. The average annual GDP per person has also risen dramatically over the past 2 decades, from below $1,000 per person in $2,000 to $3,500 by 2022, and is projected to rise above $6,000 per person by 2030. The Philippines' economy is forecast to continue to grow rapidly, with total GDP doubling from $400 billion in 2022 to $800 billion in 2030. A key growth driver will be rapid growth in private consumption spending, buoyed by strong growth in urban household incomes. By 2033, the Philippines is forecast to become one of the Asia-Pacific region's small group of $1 trillion economies, joining mainland China, Japan, India, South Korea, Australia, Taiwan, and Indonesia in this grouping of the largest economies in APAC. The Philippines is poised to become the world's 18th biggest economy by 2050, as long as it addresses its infrastructure lack. A long-term projection, made by London-based macroeconomic research organization, Capital Economics. As projected, the Philippines' nominal gross domestic product, GDP, climbing to $4,862 billion 3 decades from now. Such that nominal GDP per capita would also rise to $33,650. As of 2024, the Philippines is estimated to have a PPP-adjusted GDP per capita of $12,080, in transition to become an upper-middle-income country. Following the 5.5% growth achieved in 2023, projections indicate a surge in growth to 5.8% in 2024, positioning output 14.9% above 2019 pre-pandemic levels in 2024. The strong output performance of the economy in 2024 goes hand in hand with the robustness of the labor market. While over the past 12 months, the unemployment rate has stagnated at 4.4%, the number of people looking for employment is still at a relatively comfortable level. There is a moderate level of government debt, with the public sector debt to GDP ratio expected to have stood at 57.6% in 2024, slightly above the 56.5% recorded in 2023. The regulatory environment in the Philippines is less competitive than that of many of its peers. The country ranked 52nd in the IMD World Competitiveness Ranking 2024, compared to its 2022 ranking of 48th. Between 2025 and 2029, Center for Economics and Business Research forecasts that the annual rate of GDP growth will accelerate to an average of 6.3%. However, growth is expected to decline to an average of 6.0% per year between 2030 and 2039. This impressive growth path would see the Philippines overtake many of its peers in the World Economic League table. Center for Economics and Business Research forecasts that its position will improve from 33rd place in 2024 to 23rd place by 2039, a 10-place improvement in the rankings. The Philippines is also set to become the leading investment destination in Asia. With a solid reform agenda and unabating growth amid headwinds, the Philippines is ready to take off as a leading investment hub. The country is eyeing around $100 billion in investment deals in the next 5 to 10 years from the United States and Japan. These would cover a range of different sectors including energy, semiconductors, infrastructure, and digital economy. Tokyo has been the nation's most reliable development partner, with its massive development commitments in improving the Philippines' railway infrastructure such as the Metro Manila Subway and the North-South Commuter Railway project. The huge 2 infrastructure project alone cost more than $25 billion, which more than 80% will be financed by Japan. On the other hand, Washington has remained committed to expanding its investments in the semiconductor and IT BPO sector, both of which have been massive drivers of year-on-year growth. The sector contributes to more than 10% to the country's economy last year. Another potential U.S. investment into the country from Seattle-based Ultra Safe Nuclear Corporation will be the potential development of the small modular nuclear power plants in the Philippines. As the United States is keen to develop the country's energy sector, the envoy said a joint exploration within the Philippine Exclusive Economic Zone in the South China Sea is also expected, as Philippine companies that have been given concessions in the area have been seeking potential partners in the U.S. for a joint venture in the exploration of energy sources. Philippine energy and semiconductor sectors are expected to heavily benefit from the $100 billion investments that the Philippines is expected to gain in the coming years. There is an opportunity for the Philippines to attract investments, particularly from U.S. and Japanese firms, that might leave China in the wake of the political tension in the West Philippine Sea. Philippines' increasing bond with the U.S. and Japan could significantly boost Manila's positioning as an investment destination. The United States is pursuing an industrial policy of friends hoarding semiconductors, digital trade, and industries' transition into green energy. Philippines can achieve a huge percentage of investment by getting a share in the U.S. semiconductor industry, which is said to be worth $80 billion just in the ASEAN region. The semiconductor industry is going to be the wave of the future in terms of the technology that's going to be required for anything, from cars to defense equipment and digital infrastructures. The Philippines has been one of the most dynamic economies in the East Asia-Pacific region. With increasing urbanization, a growing middle class, and a large and young population, the Philippines' economic dynamism is rooted in strong consumer demand supported by a vibrant labor market and robust remittances. Business activities are buoyant with notable performance in the services sector, including business process outsourcing, real estate, tourism, and finance and insurance industries. As a newly industrialized country, the Philippines' economy is in transition from one based on agriculture to one based on services and manufacturing. The services sector of the Philippines overtook the industrial sector in terms of contribution to the GDP during the early 1980s, increasing from 36% in 1980 to more than 65.8% as of the third quarter of 2024, which was higher than the 62.3% share recorded in 2023. The services sector now employs an equivalent amount of the country's workforce, which is more than the agricultural and industrial sectors combined, employing more than 57.3% of the Philippines' workforce. Within the service sector, business process outsourcing, BPO, has played a significant role in sector growth. The Philippines was able to grow its BPO sector due to having professionals that spoke the languages necessary, partly due to the interest in U.S. culture, of which the country is the Philippines' largest BPO market, and the customer service-focused aspect of the professionals in the industry. Supporting the growth and expansion of the IT BPM industry offers many opportunities for other industries. A buoyant outsourcing industry bodes positively well for the real estate sector as a result of increased demand for office space and residential condos, in addition to its benefits for the transportation, telecommunications, hospitality, and retail sectors. The BPO industry, since its inception, has grown at rapid speed and has acquired significant traction in the global market share. This growth is attributable to the increasing demand of enterprises to reduce costs, focus on their core business activities, and handle problems such as a shortage of skilled personnel. The IT and Business Process Association of the Philippines said that it hopes to exceed the 2 million mark in industry headcount by 2025, citing the competitiveness of the Philippine workforce. The IT BPM, Information Technology and Business Process Management industry continues to grow. On 2024, the Philippines with 1.7 million direct jobs for Filipinos, up 8%, and generated well over $35 billion in revenue for the economy. However, the industry currently faces a challenge in meeting demand for Filipino IT BPM workers, pointing to the need for talent upskilling to offset the rise of artificial intelligence and the impact of closure of Philippine offshore gaming operators. The second important segment within the service sector is tourism, which has a long history of moderate growth. Tourism in the Philippines has not been able to tap its resources optimally and has lagged behind its regional cousins, like Singapore, Indonesia, and Thailand, in attracting international tourists. Inadequate infrastructure, airports, poor rail and road connectivity, and insufficient tourist services and facilities are among the chief reasons for this. However, with the multi-billion infrastructure project currently carried on, the Philippines' infrastructure will now able to compete with regional peers. Philippine tourism earned an all-time high revenue of 760.5 billion pesos in 2024, translating to a 126.75% recovery rate from the 2019 pre-pandemic levels. While falling short of its original target of 7.7 million, the Department of Tourism still recorded growth in the number of foreign visitors last year at 5.9 million. Another segment is export services, which include the services delivered by Filipinos working outside the country as permanent, temporary, or irregular migrants. The remittances by Filipinos working abroad have grown substantially over the years. Their jobs have also undergone a structural change from low-end service jobs to more professional jobs that require higher education skills. According to the World Bank, the Philippines received around $40 billion in remittances in 2024. This made the Philippines the fourth largest recipient of remittances in the world that year. The top 5 recipient countries for remittances in 2024 are India, with an estimated inflow of $129 billion, followed by Mexico, $68 billion, China, $48 billion, the Philippines, $40 billion, and Pakistan, $33 billion. Services have been one of the strongest and fast-growing sectors of the Philippine economy. While this performance is considered stellar by most analysts, there is still huge potential for increasing value added in services outputs, as well as deepening participation in global value chains. Taking advantage of this unique competitive advantage in the services sector, the Philippines aims to position itself as the core of services trade in Southeast Asia and the Asia-Pacific region. Indeed, the Philippines today is primed more than ever to become a leading locus of investments in Asia and the Pacific. This is made possible through the establishment of a stable, predictable, and competitive investment environment.